All right. Hey, everybody. Welcome to another episode of Ask Me Anything. We're going to go ahead and go around the horn here in just a moment. Go ahead and get those comments, questions, anything you need into the chat box. We're going to go ahead and get started in 14 seconds. Oh, I see some eyeballs just came in right now. So once again, get those questions in the comment box, and we'll see you in 14 seconds. All right, welcome back, everybody. So we got a small crew here today. Mr. Sipple, Jason Sipple, had hip replacement surgery yesterday. I can't believe he's already around walking. He actually walked out of the clinic like on his own power. It's kind of crazy. But yeah, so he had a hip replacement surgery yesterday, so he's a little sore this today. So he's going to take a break. Nagy is traveling, I believe, and other team members are having some of their travel arrangements going on. So let's go and go around the horn here. We'll start with you, Linus.
Yeah. And to add to that, Kevin Kraus is often on here, but he's not on today because his daughter had a flag football practice. So that's an interesting new thing. I guess it sounds like it's getting pretty popular. I had to look up what it is. I've never heard of it before.
Never heard of flag football?
I have not, which I'm not a sports guy, so I don't keep up with any of that. Sorry. But yeah, I am. Sorry, go ahead.
Oh, you had a little bit different childhood too. You didn't.
I did.
You should share that for those that don't know. It's very interesting, and I'm impressed by you every day with how much you've changed in a very short time.
Sure, I'll talk about that if we have a lull and don't have any questions or something. I am Linus Nolt here from Hopkinsville, Kentucky. Beautiful sunny day here in Western Kentucky, warm. I am here with a glass of Dandy Blend. You may not have heard of it. My wife came across it. Sounds like it's a coffee alternative. It's made of roasted dandelion root, chicory root, barley, and rye. Substitute to cut back on caffeine. So it's cool. I like it. And so it's like a powder she puts into a glass of milk. And I use raw milk, unpasteurized, natural stuff. All right. But yeah, y'all get your questions in the chat. Anything infinite banking related, velocity banking, anything money related, really. And it isn't Ask Me Anything. So nothing's really off limits. We might just decline to answer. But yeah, go ahead. Down to Tess.
I'm Tess Hulek. Insurance has been my life for many, many years. I love it. I love that we can help you. In Buffalo, they have a shop cat. Here's my shop cat, one of two. He keeps touching me like, I'm here. Don't forget about me. If there's any questions, we're here to help. And there's nothing better than when we find out that you guys have taken control and made your lives better than what you ever thought they could be. So
absolutely. And then, so everybody, I'm Brian Fouch here, your host for Ask Me Anything here today up in Northern Idaho. And it has been wet and cold the last 3 days, which is not enjoyable for me, but we need the rain because it's really dry up here. But starting here, I think tomorrow we hit the hot warm season. So I'm excited for that. Get out in the water, start doing some stuff. My kid's last day of school is tomorrow. Oh, sucks. But
oh, Daddy.
Yeah. But it's interesting. So I've probably mentioned this before, but my kids up here, they only go to school 4 days a week. So they have a 3-day weekend every week. It's Friday, Saturday, Sunday they have off. So yeah, it's an interesting way they do it up here, but it's just because it's a fairly small community and it's just, that's how they do it. But yeah, so 3-day weekends all year round. It's kind of cool. But yeah, tomorrow's our last day of school. So it's not going to be peaceful and quiet for me in the house. So that's fine. All right. So I don't see any questions in the comment box yet. We can go through some questions that we got from from Wealth Wednesday webinar, because we did have some questions on there. But I want to get everybody go ahead and get those comments in the question box, or questions in the comment box, other way around, right? And I see we got a live streaming on Facebook too, so go ahead and get those in there. So Tess, any questions that you saw that came up today in Wealth Wednesday that you think would be good to cover here?
Ooh, he's asking me to remember. I don't know if that's fair. I think a lot of talk today did go around I'm going to say retirement in general, because I think a great retirement plan is a plan that has multiple tools, meaning like a whole life policy, annuities, understanding Social Security. So I think there are a lot of questions. And I think what I liked seeing is that we had long-term care come up, a lot of different opportunities to kind of put your package together. Because as a person who, I could actually collect Social Security if I wanted to, because I'm of an age that the tools that we were sharing today are tools that I didn't know. And considering where I'm at in my life, I wish I had known sooner. So I think we can take back control, even though pensions are not a thing in the current world, and whole life is not a thing that the current average everyday person uses and knows. We have the ability to learn and change what the future looks like.
So I'll go through some questions that came up today and that I thought were pretty powerful. And we did have on the Wealth Wednesday today, we did have Stefan from our Private Money Club Wealth Advisor team that are financial advisors. So he gave some good advice on IULs, indexed annuity products, things that are tied to the markets. He had a really good input on that. But one question we got was, can you roll a pension? So if you have like an employer-sponsored pension plan, can you roll that pension into an annuity? Which is a great question, by the way. So for everybody who's listening, just understand what I'm saying, or what the question was. So there are things called QRAs, qualified retirement accounts. They call that qualified money. And those are things that are under the purview of the IRS, or there's rules around them when it comes to deferred taxes, that kind of stuff. So the most common qualified retirement account, QRA, is a 401k. Now, a 401k, by the way, has not been around a long time. It was only created in the 1980s, 1988, approximately in the 80s, and didn't become popular until, a couple decades later. And so it has not been around a long time, but that's the most common one right now. Then you have pensions, because in most cases, those are QRAs oftentimes. You also have IRAs or solo IRAs or Roth IRAs. Those are all considered qualified retirement accounts. You also have 403Bs, which are government-sponsored 401k plans. You also have teacher-sponsored ones, etc. Now, can you move qualified money to another qualified account? In most cases, yes, within certain guidelines and parameters. So this question was, can you move a pension into an annuity? Now, the answer is maybe, potentially, or it depends. So why do I say that? So a pension, how it's managed is dictated by the employer or the person managing the pension. Some you can pull money out in one lump sum. Some you can't. You're locked into the pension. You cannot touch your money. So in the answer to this person's question was, you got to call up your pension provider or manager and just ask them, can you roll that pension into another QRA, qualified account? It's going to be a yes or a no, or it might be a yes with these restrictions or within these guidelines. So just want to give you guys a heads up on that kind of stuff. The other most common question I get on these is, can I move a 401k into an annuity? Yes, you can, if the 401k is allowed to be rolled over. And if you're still employed with the employer, oftentimes you can't touch it, all that kind of stuff. But oftentimes you can move those funds over and get them into a more guaranteed environment versus the non-guaranteed bucket. All right. So Carrie Swanson just said, just received my first policy loan today. That's awesome. It's very cool.
She's our new grandma too.
Yeah, that's very cool. And then Kathleen, do we need to chat about an annuity? I think we do. I think we still need to set up a call for that. I know you mentioned that on the last, I think last week. So reach out to me. Let's hop on a quick call. We can do it today or tomorrow. Tomorrow's pretty wide open for me, just FYI. I know you mentioned that. All right, so that was that question. Another question someone asked here today was about Social Security. Like, when's the best time to take Social Security? Well, it depends upon what you're trying to accomplish and your goals. So there's a presentation that we're working on that actually teaches you how to optimize Social Security, because Social Security is one of the 3 guaranteed income buckets, right? And so you want to optimize it. But the longer you wait to take your Social Security, the more it gets. But once again, you've got to look at your cash flow, got to look at what you're trying to accomplish and see what makes the most sense. But once again, that's just kind of a conversation to have. Trying to think what other questions we have here. Can you roll a 401k over to an annuity? Yes, you can. Another question we got here was, hey, if I'm in my 20s, do I really need to be thinking about an annuity? Once again, it depends. But there's different types of annuities. There's annuities that you can fund yearly and just keep on funding it from down the road. And so a lot of people don't realize that you can do that. You can actually have an annuity with guaranteed returns that you're funding just like a 401k, but it's guaranteed growth. I have a client who is 25 who has an inherited IRA that they're going to roll over into, because they have to roll it over within 10 years. And they're going to roll it into an annuity that is guaranteed growth. They don't no income, but then it's just every 5 to 7 years, they're going to just keep rolling that thing into another guaranteed annuity. And that small IRA is going to grow into a very, very, very large bucket of money for that person when they're getting close to retirement age. And then they're going to convert it to guaranteed income for life. It's awesome. I think it's about $100,000 IRA. So it's not real small, but it's not huge either. So
here's my thought or opinions on some of that with somebody in their 20s, because I am in my 20s for just a few more months. So I got my first policy to start becoming my own banker 5 years ago. Yeah, 5 years ago. So I would have been like 24. And, if this individual doesn't already have their own policy that's specially designed and engineered to start becoming their own banker, then I would say that's the place to start. I mean, I guess the exception would be if they have a bunch of money in a retirement account, like a 401k that they want to put into an annuity. I mean, that would make a lot of sense, because in order to put it into a policy, you would have to pull it out of that qualified environment and pay the taxes and penalties on it. So a lot of times it would make sense to do that. But yeah, if you don't already have significant life insurance, whole life, or convertible term, maybe, I would say that's the place to start, because it is the most efficient, the cheapest time to get it. The younger you are like that, yep. And your highest income producing years are probably still ahead of you. So just a bunch of those factors are, now is the best time to start with whole life first. And also, like, if you have a spouse or you don't yet, you might in the future, you might have kids in the future, like, it is arguably better to be getting good coverage, life insurance coverage, before that even happens, so that you're not all of a sudden like, shit, I've got a wife and a kid and I never got life insurance. And then all of a sudden you got to get it real quick. And because I've been there, I've helped plenty of people that were in that position. All of a sudden you got to get it. And maybe it's even hard to get it now. You've had health issues. Like, all of those things are kind of playing into my mind here as I'm thinking about it.
Yeah, for sure. That's a good point. And now this example, and this client, I believe we're going to be doing a policy as well, because he doesn't have any dependents, doesn't even have a home, has very little to no expenses, decent income. So doesn't have any death benefit need, but he understands that, hey, it's not just about death benefit. It's also about, hey, family down the road. It's about building this thing up, about guaranteed growth, all that. The reason why he's going to do it in annuities, because he has an inherited IRA. So his dad passed away, has this IRA. Inherited IRAs are restricted. You have to actually move it from that IRA. I think it's within 10 years, you got to move it out. Otherwise it cancels, and then there's going to be a huge tax event. So
move it out into what, Brian? I'm not familiar with this.
So with an inherited IRA, you got to move it over to another qualified account.
Okay, that's what I was wondering.
You can move it into a regular IRA, you can move it into a solo 401k, self-directed IRA, or an annuity. But he's like, hey, I don't want to worry about this money. I'd rather just park it and forget it. Well, if it goes into a 401k, then it goes into a mutual fund. Well, now he's going to worry about it because it's in the markets. He puts it into a self-directed IRA. He can put it wherever he wants. He can put it into real estate. He can put it into markets, all that kind of stuff. But once again, those aren't necessarily hands off. And so he's like saying, what's the best option for me to just use this money down the road, but I don't need it now? It's an annuity, because it goes from a qualified account to a qualified account. But that's the annuity, though, has guaranteed growth. And it turns into guaranteed income. So once again, guaranteed income, guaranteed growth. I love that word, by the way. So that's why he's doing it that way, because he can. So it just makes the most sense from what he's trying to accomplish. The policy is going to be more of a fund it, and he's going to be building an opportunity fund. So when something does happen, that's an opportunity, like, hey, there's an investment, hey, there's this or whatever it ends up being, he has liquidity over here that he can go grab, versus like a 401k, which has that option in it with his employer. He doesn't like it because he goes, it's my money, but I don't control it. It makes no sense, and there's no liquidity. Yes, it was a 401k loan, but that's not the same as infinite banking. So that's what he's doing right there.
There is something I really like about annuities that I want to dig into a little bit more too, is that with annuities, you have kind of like two periods of time. The period of time that you're annuitizing it, you're building it with money, and then the payout time. But there's something called a rider, and everything has a rider on it. And when we had our 3-day blueprint training, Alec was talking about you can get an income rider put on some other types of annuities where you don't have to have an absolute. You turn on the income and it goes forever. You can turn on and off that income as the need arises. And I love that idea.
Yep. Yeah. Yeah. Annuities they're not as flexible as life insurance, but then again, they're a more specific purpose.
Right.
Just income, guaranteed growth, guaranteed income.
Yeah, and that's at the income phase, because that's the part I'm talking about is the guaranteed income. Because I do think life insurance for financing the big family needs, and income kind of to cover the day-to-day expenses that are not going to be covered by your paycheck at the time that you go into retirement.
Yeah, absolutely.
So two sides of it.
All right, so Kathleen's got some questions inside here. Let's see here. So this says policy loans, you only have to pay back interest yearly. True? No, you don't even have to pay the interest.
Yeah.
Yeah, so there's literally zero payment you have to make. If you don't pay the interest, what happens with most companies, and I believe it's the same with One America, they just roll it into the policy balance automatically. So like my Lafayette one just did it right now. I just saw it happen. They don't even they didn't ask. They just rolled it in there. So if I want to pay the interest, I would just go make a loan payment for that amount. But it was such a small amount this year, I'm not even going to bother paying $100. It's crazy. So it was a low amount, so I'm not going to bother.
I think she's got two other pieces to her question. There you go.
Is it to my advantage to pay back any loan because that builds my cash value faster? Why pay it back? What are the advantages? So let's take that one.
Well, I think part of it is we want to become our own bank. We want to start operating this as a banking system. And you don't want to, you're not using it as a bank if you're pulling it. There are some people that operate that way. We have heard of a few, but the purpose is to use it as that tool where you're accumulating for that big financial purchase. So do I always pay back? It depends on where I'm at and where my cash flow is and what I'm facing. So it really depends. But in a perfect world, I'd want to be paying those loans back, paying that interest back, because we do know if you are paying interest back over the course of a year, the amount of interest that you're going to owe on your policy is less, because it actually applies to principal during the time that you're making the payments during the year. So I guess it's always back to that question, depends, but I want to operate outside of the banking system as much as possible. So I want to utilize that as my banking system, which means set up the bill pays, keep paying them back. But am I 100% on that? No, it depends on cash flow and what's coming in.
Yeah.
Mm-hmm. I would want to clarify one thing, and because you're asking, does that build your cash value faster? So let's differentiate. Cash value is actually what's inside the policy, the value of the policy. Your policy loan is more like a line of credit that is being collateralized by that cash value. So, and because we use non-direct recognition companies, the cash value growth is not affected whether you have a policy loan outstanding or not. Bigger loan, smaller loan, none of that matters. Cash value growth is going to be the same whether you have one or not. So it is important to know that. But then the rest of what you're asking about is what are the advantages? Well, the advantages are, you're basically replenishing your system to where you then have more available to use for the next opportunity, whether that's to invest, to go pay off debt, or to just finance major purchases in your life. So those are the advantages. It would also be in owing less policy loan interest, like was mentioned before.
Yeah. And also, Kathy, be clear here. When you pay back the loan, it doesn't build your cash value faster. It just replenishes the cash value bucket so that you can borrow back out again.
The amount that is available to borrow, yes. Yeah.
Now, that being said, like let's say you borrow $10,000 and with interest it's $10,100. But you say, well, what if I want to put in $10,500, $11,000? There may be room on the policy for some additional PUAs, which will build the cash value, but that's separate from paying back the loan with interest. So let's keep that in mind. And by the way, on our next call, we can always go through that. But the last thing I'll mention is like if you go get a car loan from a bank, are you going to pay that loan back with interest? Absolutely, because they're going to take your car otherwise.
Absolutely.
So one of my rules is treat your bank better or the same as you would a traditional bank. So not paying back the loan is me treating my bank worse than I would a traditional bank. So I always want to treat myself better. But as Tess alluded to, there are scenarios, paying off bad debt, where you may not pay back your policy loan right away, but you should always have a plan to pay it back. The last thing I'll mention is, how would you pay back the policy loan? Depends on what you're doing with the loan itself. So if I'm investing in real estate that does not cash flow, I'm doing a flip as an example, I'm not going to make payments back on my policy loan until I sell that project or property and get a lump sum capital, and then I'll pay back the loan one fell swoop. If I'm going to get a car with my policy loan, well, I'm going to mirror a car loan, which is a monthly payment back with, I'll just map that out. So whatever I'm doing with the money is how I'm going to structure the payback of the loan. So it just depends. Let's see here.
And it's beautiful using your system, because if you are doing your bank and you're paying your card to your banking system, if something happens and you lose a job, you can adjust your payments or put them on hold. If you've got that still in the outside with your bank, you're not going to have that option.
Yeah. And I'll kind of throw in a little kind of curveball here as well. So let's say that you're doing a private lending deal and there's no cash flow for like 12 months. So your money's out there earning a return. When they close the deal 12 months on the road, you'll get a big payday. But let's say that, okay, so your loan's sitting there, you're not making any payments back on that loan. But let's say for some reason you have another thing over here, an account where you're saving a couple $100 a month for some purpose. Doesn't really matter what it's for, but you're saving cash in a checking account or savings account over here. Does that make sense? You don't need this money in the savings account right now, but is that money working for you in that account? No, it's not. It's just sitting there. You're adding $200 to it every month. Well, I would not let it go into the checking account. I would put it into the policy loan. Why is that? Because I'm just saving it in a different bucket. That's all I'm doing. But it's more efficient in the policy loan bucket because now the loan balance is going down, which means less interest overall. So I'm actually making more money. That's how I look at it, though, because I'm paying less interest on a loan. And then when I need the savings, just take a loan back out again, and there you go. So it's just a matter of where you park money. It's very powerful. As Linus alluded to, pay yourself first. Don't give it to the bank, give it to your bank first. So lots of ways to do this. Let's see here. And then, yeah, Chris, you're right. So what he's referring to here is what Linus alluded to. There's two different types of insurance companies, direct and non-direct. A direct recognition, when you borrow from the cash value, it affects the dividends. Your dividends go down because they reduce the amount you're going to earn dividends on by the amount of the loan. With non-direct, who we typically prefer to work with, it doesn't matter. You borrow or not, you earn the same dividends because they don't recognize the loans against your cash value when it comes to the dividend calculation.
And dividends are important because when a policy is set up for infinite banking, and this is something that's automatic, you don't have to worry about this, but I'm explaining what happens. The dividend, when it comes in each year, it buys more PUA death benefit. And so it's increasing your death benefit, permanent guaranteed death benefit once that's done at that point. And it all of that dividend then also becomes available cash value, an increase in cash value. And over a long periods of time, that happening every year, you have drastic increases in death benefit and cash value amounts. And of course, increases in, well, I guess dividends wouldn't be earned on dividends, but it's very powerful. And so and I've seen this in say a direct recognition like Brian was talking about, where dividends actually gets reduced when there's a policy loan outstanding. The long-term effects of earning less dividends are quite significant. So you got to be aware of what you're getting according to what you're going to be using it for.
Yep, 100%. All right, so my Russ, I'll say that 3 times fast. The question here says, can you use a policy for leasing a car if you're used to leasing cars for 3 cars, as I don't see a car as an asset, and with technology always improving within cars and the repair costs along with them? So I think I'm kind of gathering the question here. So a lease is a different structure of getting a vehicle versus a loan. So you can't really lease from your policy because a lease is only going to be from a car company. or a car, kind of using a bank. It's a bit different because a lease is like you temporarily own the car, but at the end of the lease, you don't own the car anymore. So you really don't even own the car with a lease at all. You don't even get the title. You're just renting the car. So that's how I look at a lease. It's just like what is a lease on a rental property called? A lease. It's a rental. So if you're going to use your policy, it wouldn't usually be structured as a lease because that's renting the car from the car company. Whereas with a policy, you take a loan, that's cash that you would then buy the car with.
Mm-hmm. I mean, it's not impossible to use policy loans to pay the monthly lease on a car. Mm-hmm. I don't think it would be a great idea. I mean, that's everyday expenses, and you wouldn't normally borrow money to pay expenses. So I don't see that being an advantage. I guess one exception I'm thinking of, and I'm not sure if this is even really a thing, but say you get a 3-year lease deal and they give you an option and a big discount by paying the entire 3-year lease up front, then it could make sense to take a policy loan, pay that entire lump sum, and then do the normal, what you would have done as monthly lease payments, as policy loan repayments back to your policy, and basically pocket the savings that they had given you. That could be an approach, but I'm not even sure that kind of lump sum lease agreement is a thing out there.
Yeah, I don't know either.
You have balloon payments at the end of a lease so you could buy the car if you wanted.
I have a client doing that right now, actually, with the policy.
Yeah.
He's buying out the lease, or no, the father's going to do it for the son using his policy. But the other kind of thing to look at when you're looking at assets versus liabilities, because she just mentioned, or they mentioned, that they don't see the car as an asset. Now, when I think of an asset, there's a couple different types of assets. There's an asset that grows, like a 401k, those kind of things. They're just growing. But then you have what I call cash flowing assets. Pretty simple. Those are assets that provide cash flow, and they're going to provide it, like clockwork. And so, let's say you take a policy and you go and you acquire an asset like a rental property that provides cash flow. Maybe it's $1,000 per month. Well, you take $1,000 per month. 500 of that goes back into your policy loan, and then 500 it pays a lease on a car. So now you've got an asset that is paying for your liability. When you're done with the car, done paying back your policy, you still have the asset. You still have the real estate. And guess what? Now you just repeat the process. You get another rental property, then another, and then another. Eventually, you're going to have enough assets that pay for your liabilities, such as car loans, mortgage, rent, whatever. Now, that's kind of a high-level overview, but that's kind of the thinking that you've got to start getting into when it comes to things like this, because you're right. It might not make sense to get a car or buy a car with your policy if you can go create an asset first. But pros and cons of each. Let's see here. Any other questions we have so far? Yes. Yeah. Chris Seeger says opportunity cost. Yeah. Love these answers. Yeah. We definitely look at the policies. Like for me, one of mine is it's probably going to have to be used for taxes now, which I don't like. But it's my opportunity fund. It's been sitting there, not touched. But 2025, I am going to have to pay taxes, federal income tax, by the way, for the first time in 8 years.
Uncle Sam is appreciating your opportunity.
Yeah. I'm not, and I'm a little leery about what my tax bill is going to be, but it's going to be fun. But what I'm going to do, though, by the way, so this is my strategy. So I'm going to borrow from that policy to pay that tax bill, and then I'm going to calculate the monthly that I need to save for the next year, and I'll use that monthly to pay back the policy loan, so that next tax season, I just borrow back out again and pay my taxes. So I'm just using that policy to run my money through it to pay for taxes. But in the meantime, I'm earning dividends and it's growing, death benefit, all that kind of stuff. Mm-hmm. So that's how I do it.
As long as they don't force you to do quarterly withholding or whatever they call that, quarterly estimated tax payments.
Yeah. They want you to. I know that, and I'm not too keen on that either.
Yeah. Usually you can get away without it. You just basically avoid giving the IRS the 0% loan throughout the year.
Yeah. That's my thing, and they're going to come back and probably want to tack on a little bit of a little surcharge for that right there. But last year, by the way, I had a loss in a business. So I was closing the business down. That's why I didn't have any federal income. But the government cut me a check for $6,000 as a tax return. I had not paid federal income for years, and yet they're pay me. If you don't understand what I'm saying, that is the definition of government inefficiency and stupidity. How the heck are they cutting me a check when I had not paid anything in the taxes? Makes no sense. But once again,
several years in a row. It's called earned income credit, and also the child tax credits.
Yep. Yeah. It's just ridiculous. And I mean, there's a year where they paid me $24,000 one time, and I paid $0, and they cut me a check for $24,000. That was awesome. I'll be honest. That was very nice. Now, how did I do that though? So I had oil and gas investments. So oil and gas investments that have significantly large tax deductions and write-offs. And so I was able to use those, and however my CPA did it, they did it, but they cut me a pretty nice check. Yeah. I was not even expecting it, by the way, either. That was the best thing. Like, oh, here's your money. Sweet. Let's go buy a boat.
Yeah, Chris Seeger, we certainly appreciate you being here.
Yeah.
Oh, Chris Seeger, yeah. We adore Chris Seeger. He's awesome.
Yeah. Like says, Carrie says, yeah, sign me up for that program. You don't want the program that I went through. Because there is a pro and con to my story right there. The con is, how do you have zero income tax, even if you have income like I do? You have to have business loss, or have to have some massive deductions or write-offs. But I had business losses through a business that, because of COVID, was taking some big hits. So that's part of how I did that. But also, I ran a lot of my income through a multi-7-figure revenue business. And then because of that business, I would take income out of it enough that it would actually get the business profit to be basically zero. And I had all these deductions. So that's how I did it. And but yeah, it worked really well for many, many years. So, but I don't have that business anymore. So there we go.
Yeah.
All right.
But in that scenario, it's pretty hard, if not impossible, to qualify for any kind of bank financing, because you're showing next to no income or very little income on your personal returns.
Correct. Now, I was very fortunate, and this is not like a brag really per se, but when I set up that business, I got actual business credit and credit cards that were not personally guaranteed. So when the business when COVID came and went south, I was like, okay, done. And the credit cards, they had a balance on them, and they were not, I'm not gonna be honest, it was not small, but there was no repercussions for that because it was not tied to me personally. So in business, there's a lot of things you can do, but you have to have a good CPA. I'll just go there. Oh, and also I use the Augustus rule quite a bit too. So that was able to transfer a lot of income into my personal, accounts tax-free and deduct in the business. So I don't know if anybody knows about the Augustus rule. You use that, don't you?
Yeah.
We know about it. We've been around this campfire. If you don't know about it, get on Wealth Wednesday.
Okay. So Carrie, here's what I'll mention to you. So she says here, she's referring to, if you report no income like I've been doing, you can't get business credit, or you can't get credit, period. You can't get loans, mortgages, all that kind of stuff. Now, she's saying that's why I can't get a HELOC at the moment, too many write-offs. Not always true, by the way. So I have not showed any income, but I'm in the middle of a HELOC right now, getting a HELOC. So the requirements still are the same. You have to have the credit score, you have to have the debt to income ratio. But the key here is that certain banks, and there's not many of them, by the way, don't need to look at your tax return per se. They can look at your earned income through your bank statements. So I got approved. And by the way, I have zero tax returns, showing income, right? It shows my self-employed income though, but they show zero, but they're using my actual bank statements to show income and verify, and that they approved it on that. So you might be able to get a HELOC, Carrie, even if you don't have the earned income on your tax return. Yeah, we're going to get you more business credit. Yeah, I had a lot of business credit, by the way, and it was all personally guaranteed. A lot of it was, not all of it, but a big chunk of it was, and I'm talking like $400,000 to $500,000. So not small numbers. And shut the business down. That debt does not go away. Not fun. I got to do some stories on that, because those numbers are, for a lot of people, are very large. And that's one thing I'm dealing with right now. So Ashley, by the way, you need to come by and help me install my well pipe. Yeah, she's our best friend. Yeah. So, what's a better starting place, real estate or private lending?
Well, that's
Okay, that's a great question.
They're kind of the same thing.
yeah.
Kind of are the same thing. Me personally, I would do real estate because you're hands-on on the asset, and when you're hands-on, boots on the ground, that's where you learn the most. If you haven't done real estate and you want to do private lending, you've got to learn private lending, which means you got to go learn real estate anyways. How do you do due diligence? What's a good deal? How do you vet an investor who's going to be borrowing your money from you? So I would look at more hands-on. And by the way, we've talked about this, Ashley. I want to get into some certain strategies, and you and I can partner on that kind of stuff because we're obviously neighbors, and it'd be good to have a dual person going into strategies. Just help spread things out. But I used to teach real estate investing for people that don't know this. I used to teach that. But there's some pretty cool things you can do in real estate. But private lending, it's you can mitigate the risk. But what most people do is they'll build up a nest egg by doing real estate, take the nest egg eventually when it gets big enough, and then start being less hands-on and doing more private lending. That's the thing I see people do a lot, because you have to have a certain amount of money to private lend, and it's not like $5,000. It has to be quite a bit more. Let's see here. Okay, so you are talking to CMG. So CMG is who I'm working with on my HELOC too, by the way. So just keep talking to them. They're pretty good.
The statement-based lending with CMG is a fairly new thing. So it just depends, did she talk with them before this was a thing? Maybe you should talk to them again. Think about it.
Yeah, they've been doing it, I want to say a year.
Okay, I thought it only started this year.
Might be this year, but I reached out to them about, 3-4 months ago to say, hey, is there any way I can do this? And then that's when I found out about it. I didn't know that. And so Kathy says, recommend Brent Carlson and team at Corporate Capital for taxes and legal. Because they've been working with them. So Brent Carlson over at Corporate Capital Inc., I think it is a group. They do tax strategies, tax planning. They do bookkeeping, all that kind of stuff. They do business structuring and business entity creation. And they also do estate planning, so trusts, all that kind of stuff. And Brent and his team are familiar with infinite banking as well. And so they can work with us and together on those kind of strategies. So if you're doing any kind of thing, estate, trusts, all that, just let us know and we can do a personal introduction to Brent and his team for you. Because they're working probably with about 40 of my clients right now, quite a few. I love this one. So Roy is asking, max out PUAs over paying back policy loan. Thoughts? So
I always, if there's room to put more PUA in, that's where I will go. But there's always been debates on this team about which direction to go.
Yeah.
But I like PUA myself because that means that I'm going to grow the death benefit and the cash value.
Yeah. And Linus, what's your take on that one?
I concur with Tess there. And it's, you got to think about what you're doing, because if you are going to need the money soon, it's like, how long do you continue shoving money into PUA and borrowing right back for a policy loan to keep doing stuff, whether that's investing or absorbing third-party debt? How long or how far do you want to keep growing the policy loan too? Because that's what you're doing if you're constantly just running straight through. Because I've done that for a number of years to finish absorbing third-party debt. So it kind of depends what you're doing, but I certainly do lean towards PUA over paying back policy loans. But then, like retirement coming up, depending on somebody's plan or strategy for that, then that could change recommendations here too.
Yeah.
Yeah. And if you have a policy loan that's outstanding, it depends on what that loan is doing for you as well. That's how I look at it. Mm-hmm. Is that loan providing cash flow back to your policy and you pay back the loan? If that's the case, then it's an investment as an example. Well, if that's the case, then I would definitely take that cash flow, fill up the PUA bucket first, and then go back to the policy loan, because you have an asset that's doing that anyways. If you bought a car and you're making a payment out of your pocket back to the policy loan and you have additional PUAs, I probably wouldn't stop making the car payment back to your own policy loan, because you want to keep that structured. That's just my opinion. But if you have additional funds you could put into the PUAs, then by all means fill up that bucket too. So if you have the ability to have this problem, which is a good problem to have, just reach out to us and our team, and we can walk through different scenarios because we've probably seen them all.
Yeah, here's one way to think to look at it too, or to think about it. Paying back the policy loan is like making a payment on a line of credit. You're just reducing the balance, essentially the outstanding balance. Whereas putting money into PUA is more like getting an actual limit increase, a credit limit increase, where you now have a bigger total line of credit to work with. So that's one way to look at it, death benefit aside.
Yeah, I like that. Good one. I like that one. Yep. And so, yeah, so Carrie's working with corporate capital as well, doing trusts and taxes. That's awesome. Mechanic Coke, here's another question. Says, do you guys have a video or stories on common mistakes people might make at the beginning, even if they work with you on getting a policy? I mean, I don't know if we have like a video specifically on that. We might have them. I'd have to go back and look. I mean, but I'll give like one, and then we can all give kind of an answer on this one. A real common mistake that people make is not talking to us, not communicating with their money mentors, not being on these kinds of live stream events consistently. Because at the beginning, that's when you need guidance the most. So reach out, have conversations, work with our team. That's number one right there. If someone goes and does something but doesn't talk to us first, and so it's like getting the keys to a brand new car, getting in the driver's seat, but you've never driven a car before.
Yeah.
You need that guide. So, Linus, how about you?
Yeah. Clear and regular communication with your mentor. That's for sure. They're kind of, what I'm seeing is they're kind of asking common mistakes people make even when they're working with us. So I guess that aside, I mean, I even had this, which I fixed it, but not thinking big enough starting out. Which is different for people as far as like education or confidence level. For me, I was fully confident in that it works, and I wish I would have gone bigger in the beginning rather than try to, get more policies. So, I mean, I don't know if that's necessarily a mistake, but it can be. And also, kind of in the same vein, not building your system big enough for future windfalls potentially. If you know that you're going to be getting future windfalls, so in a sense, kind of a lack of long-term thinking. Maybe long-term thinking is a big part of infinite banking. You're thinking beyond just next month and the rest of the year kind of thing. You need to be thinking the next entire 10 years and 20 years, all the way out to retirement age. And then after that, like, think of it just a little bit bigger than what you probably are.
And where I'm going to go is I'm going to say honesty. And I think it's because sometimes, and this is in a couple different areas with the process. When it comes to your finances, we are going to see people that are in a lot worse situation or in a lot better situation, but we're better equipped to help you if you tell us everything up front. That goes hand in hand with underwriting as well. Underwriters are going to uncover things that you don't know about. And I often equate it to being a parent. Do you want your child to come to you and say, hey, Mom, I broke the window next door? Or do you want the neighbor knocking on your door going, your kid just broke my window? You want to tell us, because we can smooth it by letting them know, because then there's not a question of what else didn't they tell us about. It's like, oh, they were up front, so they're trying to provide us with the most information, because you're not in the worst situation and you're not in the best situation, and we can provide you with the best help if you just tell us everything honestly, so that we can piece it together and give you the best possible solutions and give the underwriters the best possible information to get you to your policy faster.
And one last one I'll mention here is not having a plan to pay back your policy loan. So that question comes up quite a bit, but a lot of people will borrow, and then 3 months go by, they're like, oh, shoot, yeah, I forgot. I probably should pay back that policy loan, because they haven't even thought about it. So having structure to your loans and a plan with them is paramount. And so what I see a lot of people do, because you mentioned here, if you work with us on getting the policy, but you got to work with us after the fact as well, not just on getting the policy, but using the policy. And so we can work with you on how to structure loans and all that kind of stuff. But yeah, not doing that is a big one I've seen before. Carrie says, yeah, so she plans on maxing out her PUAs this week and then taking out a second loan to pay off another loan. So a loan from her policy to pay off another loan. Let's see here. Do people get rid of their credits? I think you mean like credit card for everyday expenses and just use their policy and pay themselves back. No, I would not recommend that. I would not recommend using your policy to pay for everyday expenses because there is no vehicle to do that from your policy. That's the first thing. You can't take loans every single day for $10 purchases. You can't do that. There's no debit card tied to your policy. So think of it this way. Banking transactions and banking functions. Transactions are your day-to-day expenses, paying for groceries, gas, milk, etc. That's your credit card, your debit card, your cash that you have for those things. But then you have banking functions, which is the borrowing and lending of money. Independent banking is on the borrowing and lending money of that, not on the expenses side. Now, either one of you want to take it to where you can at some point down the road get to that point?
I'm not sure what you might be alluding to. One thing I'm thinking about is if you have credit card balances that you're not paying off, they're just sitting there and you're paying exorbitant amounts of interest on them. That's where you maybe the best use of your policy loans would be to take policy loans to wipe out that credit card debt and then start redirecting the payments that had been going to those credit cards now to be policy loan repayments. But then, habit-wise, do you need to get rid of the credit cards so you don't rack up the next balance? Or can you handle this credit card now with just spending wisely, not overspending, and then paying the balance off every month as it's due, rather than continuing to rack up a balance again and incurring big amounts of interest?
What I was alluding to is that, and this takes time, by the way, not 5 years, not just 10 years, not even probably 15 years, but a little bit longer. As your policy starts to grow and compound down the road, the compounding could be generating so much cash value growth that yes, you could take loans from the policy, pay for your general expenses, everyday living expenses. That's just a source of income, by the way, and not pay back the policy loan. But that's a retirement strategy of income and retirement, most likely, and it takes time to get to that point. And Nelson Nash talks about that in the book, Becoming Your Own Banker. He talks about that concept. But once again, that's not something you do day one. It might be year 20 or year 15 or year 30. Depends on lots of factors.
Yeah, because you really want to master the process before you start getting into advanced techniques.
Yeah. Yep. All right. Black Cat Syndicate says, if we become a client of one of the BYOB reps, do we still have to pay to use the vault, or do we get access as long as we are clients? So the vault is a subscription model. So it just is. So keep that in mind. It is subscription based. It doesn't matter if you're a client or not, because the vault is available to anybody who has policies that wants to use it. Now, as mentors, what we will do is we will show you the vault. We will look at your policy. We'll load it into the vault, run all the numbers, and you can see it. And then if you don't need to use it, that's fine. If you said, hey, Brian, can you just run my debt blaster report inside there and just send it to me? Yeah, I'll do that, and I'll send it to you. And then if you don't want to use the vault for any other features, you don't have to. But yeah, we will show you the vault, the options, show you how to use it. We'll look at your policy inside the vault so you can see how it looks. And then you can determine if you want to get a subscription or not. Yeah. But yeah. All right. Any last minute questions, or we're going to call it a day here.
Or is Linda's going to share a story?
Yeah. So she was talking about credit cards. That Conda Coke was. So yeah, as Linda's alluded to, we can map this out for you, by the way. But oftentimes, if you have a credit card debt, getting rid of that is going to save you so much money and build wealth so much faster, because you don't understand how destructive credit cards and things like that with high interest are to your wealth, to your money. It's so destructive. Average family before COVID was paying $19,000 a year in interest only, just pure interest. The average American household. That's gone up, by the way. It's gone up. I don't remember the number now, but it's kind of scary. And I think right now we have the highest credit card debt in history of the U.S. Mm-hmm. That's not
isn't the stat that the average American family pays like over a third of every dollar of their income out in interest by the time they they account for the amount of interest that they're paying out in their mortgage, along with their car loans, student loans, credit cards, all that kind of stuff.
I haven't seen them lately, but Joe Kovacevich's word, that's devil's math.
Devil's math?
Yeah.
Yeah, that 33%, that's a lot to be paying in interest.
It gets into the one of the big concepts Nelson Nash talks about in the book, Becoming Your Own Banker, right here. And if you don't have it, you should have it. Sorry, my screen might be mirrored there, but Becoming Your Own Banker by R. Nelson Nash. He talks about it's not about the rate, the interest rate, the percentage. It's about the volume of interest that's actually getting paid out in the life of a loan. And so it's very important to pay attention how much interest you're paying, not necessarily just the rate.
Yep. All right. I think we got all the questions. I just put in the link here, by the way, our link to grab a time with one of our mentors. So go ahead and grab that. And I'm also going to put in our phone number. So we do have an 866 number that you can call. And then there's some options for infinite. Oh, here we go. Tim's got a good question here. It says, if you have a convertible term with Mass Mutual, will they let you convert and dump extra money into the new permanent policy at the same time? Ooh, I like that question. So, Linus, you want to take that one? I know you know this one.
I don't for sure, because I'm not familiar with Mass Mutual's guidelines on what kind of whole life policy that you can convert to, because every company has different guidelines on that. I believe so. I believe the answer is yes, but I do want to leave the caveat that there may be some restrictions that might limit what kind of designs we can do.
Yeah. Yeah. So what typically they're doing, by the way, with convertible term, and I believe Mass is the same, is let's say you have $1 million of term, you can convert that to $1 million of permanent coverage. But once again, Linus, do you know when you do that, if the $1 million will also apply to, if you have like a term rider in the whole life policy, does that apply to that term policy as well?
Yeah, it would be the total amount. And a lot of companies won't even allow a typical term rider on a new policy that was from a conversion. I don't know what their guidelines are at Mass.
Yeah. Now, Timothy, the other thing to keep in mind is that it's not very common to convert term to whole life. It's very rare. Linus, how many of them have you done?
I don't think I've done any actual conversions yet.
Yeah. I know that I believe Chris said he's been involved in them before. But why would you convert term to whole life? It's because you're uninsurable. What's that?
To keep it.
Yeah. But the reason why is because you're uninsurable. Because if you're insurable, you don't need to convert the term. You just go get a whole life policy and then cancel the term when the whole life goes into effect. But if you've had a heart attack, you've had cancer, you've had something, you have a chronic illness or a disease that came up after the term policy, and you can't get a whole life policy, that's where the term conversion allows you to go get a whole life policy without the medical. So that's why the term conversion exists, but it's not common because most people, when they go to get a whole life, they're insurable. Because if they already got a whole life, or a term policy, unless something changed drastically, they're still insurable. So yes, I have not seen one yet either. I've heard of them. I know agents that have done them, but we don't see them very often. And also, by the way, if you convert the term with the same company that they gave the term, and the whole life is with that same company, it's a lot easier. I've very rare. A lot of companies don't like to take term policies from another company and convert it into their whole life. They only will accept certain types, by the way. Okay, then Chris says, "Oh, look at this." He says, "My wife's pension protection term is being converted as our cash flow allows." Interesting.
Perfect. Yeah.
So a convertible term doesn't all have to be converted at once. It can be converted in little bits as you want, or as you have the cash flow for a whole life.
Yeah. Oh, and then so she's saying her human life value is maxed out to protect her family. So it's interesting. So I'll just share this kind of thing here. Someone was saying, "Hey, I want to get a whole life policy." They can't because they don't have any income. I think they're just now getting Social Security, but that's it. They don't really have any other income. And the person though has cash. They have quite a bit. And they're saying, well, and I was just talking to him and I was like, wait a second. So just so you're aware, if you go get an annuity, the income from the annuity is income.
Yeah.
So they're saying, wait a second, Brian, could I go get an annuity of like $200,000 or $300,000 income right away? They're at that age where it makes sense, but then I don't need the income from the annuity right away. Could I take that and use that as a premium on a whole life policy? Yes, you could. So there's lots of ways, by the way, to lap these things over each other to accomplish certain goals, by the way.
Yeah. Another approach to that one, Brian, could be to go through underwriting. Like they will allow for, say, the intention of liquidating a certain asset or a certain account into premiums over a 10-year period or something like that, even if the client shows almost no income currently. So that could work. Also, and as far as qualifying for enough death benefit, I'm thinking they have a big enough net worth to probably qualify.
Yeah, I'm having a challenge with someone right now who has like 1.9 million of cash and has like 130,000 guaranteed income.
Mm-hmm.
And they don't like the death benefit on the policy because it's a large death benefit. But that's the challenge of some of these things. But the whole purpose of that one is to actually move that 1.9 million into a more secure environment inside life insurance. And so we're trying to paint the picture here to see if we can move that forward. But yeah, the big life human value there on that one. So they have a lot of liquidity. But yeah, good question.
So the underwriter was balking at the amount of death benefit on the new policy.
Yeah,
Mm-hmm.
the unearned amount, because their life
it just needs to be set up for estate preservation purposes, not necessarily income replacement purposes. So there are different documents involved with that.
Mm-hmm. Yeah, so I just sent over. It's called a cover letter. Everybody who's listening, so we just sent one over that says, "Hey, this is for legacy protection and planning and preservation of this capital for generations." And so, but you got to keep in mind, like their life value is $2 million. The policy is 5.6. So it's a big difference, but that's why we do what we do. All right. Well, we're actually 1 minute over. So sweet. So we made it. So any other last minute questions? Otherwise, we will let you all go. And by the way, we do these events every week. So make sure you subscribe if you're not already to YouTube channel for Chris Noggle, so you guys get alerted to when we do these live streams every week. And then we also do other events. But with that, you can go to chrisnoggle.com to get some more info on the events that we do every week. We just had 3 today, so this is our last one. So, all right. Well, appreciate everybody. Appreciate all the phone calls, and look forward to talking to some of you on a call. But Kathleen, let's hop on as well. Just reach out to me whenever you have a chance, and we'll talk. All right. Take care, everybody.
Bye, everyone.